Let's bring in Warren Hogan now. Of course, he's MD at EQ Economics and advisor at Judo Bank. Warren, what are your key takeaways from those GDP figures today?
Yeah, good afternoon, Kieran. I think they confirm we have a very strong economy coming out of this pandemic. I think we knew that. But unfortunately, they confirm just how much inflation's being generated. Effectively, we're at risk of overheating the economy. So that has some significant implications for policy, both monetary and fiscal policy. I think the second point that the numbers really showed out today was how strong government spending is of all levels of government across the economy. Public demand grew by 7.7% over the year compared to private demand at 3.7%. Government consumption grew at 8.3% over the year. So the government can't keep spending at this pace. It has to slow down. And of course, in an economy with capacity constraints and a lack of workers, they're adding to the problems for the rest of us by continuing this strong spending. So that's another point I think worth noting. And then finally, business investment and investment more generally in the economy is okay. It grew in the quarter, but that is our ticket to higher productivity and higher real wages over the next 3 years. And that has to be a priority for government policy to make sure businesses are investing, because that is what delivers productivity growth over the medium term.
So consumption strong, but Warren, how are households going to cope with these increasing cost of living pressures? They're not going anywhere.
Yeah, there's some good news on the household front. I mean, income growth is starting to really come through, and that's happening because people are getting jobs and they're getting higher wages. So there's some further evidence that wages are starting to rise. And that, of course, is going to be critical in dealing with rising cost of living. We've got some pretty scary developments in domestic energy markets, which could really have an impact. I think the key is we're not seeing any impact on spending yet, but that's what we've got to look for. When households, particularly low and middle income households, stop spending on discretionary items, start retrenching spending in certain parts of their economy because they've just got to make ends meet, that's where we've got to watch for. That's not in this data yet. Households look well prepared. And of course, employment is key here. That's keeping things ticking over.
The economy is resilient, Warren, clearly from those numbers today, but can the inflationary cycle and rising rates derail everything?
Well, it can if it intensifies, and I think that's why these developments in domestic energy markets with gas prices, with electricity prices, are absolutely critical. And I think you've been talking about this today. But if it's inflation of 7 or 8%, I don't think it'll derail the economy. We've got strong employment growth. Wages are starting to rise. I think even the housing market's going to surprise people, given that with higher wages, people will be able to afford higher mortgage payments if interest rates are going up. So as long as the interest rate increases are modest, and that is a percentage point or two over the next year, rather than anything more significant than that, then I think the economy will remain resilient despite a lot of volatility and a lot of concerns throughout different sectors of the economy.
What does the RBA need to do next? Do they need to go big next week, Warren? Because you've been saying to me and to our viewers that they've been behind the game for a lot of the last year or two. Do they need to catch up and go big next week?
They do. They need to go big next week. They need to keep going through the back half of the year, but they need to be measured. And I think they will be. Before the pandemic, low interest rates didn't create inflation. All of the reasons that was the case have gone. And we've got inflation, and those interest rates have to return to normal. That is an absolute priority in this economy. There's very little anyone else in the economy, whether it's government or otherwise, can do about it except the RBA. So they've got to go, I think, at least 40 basis points next week. And then they've probably got to get it up to about 1.5% by the end of the year and 2.5% by the middle of the year. And that will create some issues, particularly in the housing market. But I don't think it's going to create a significant downturn. I think the economy will be pretty resilient to that.
Well, that's good news. And what are the implications of all of this as we look ahead and your crystal ball out for October and the government's economic plans, October being their scheduled early budget after taking office?
Yeah, well, it's a long way away, October, given the urgency of the challenges, particularly around electricity and gas prices. The government's going to have to act before October. But I think really the reality with fiscal policy is that it has to be reined in. Governments can't keep on contributing to the economy when it's got a shortage of workers, when it's at a capacity that's creating inflation. And I think it would be wise for them to tighten things up a little bit now and set themselves up to do something more strategic in their second or third year of this parliamentary term. So I'm hoping that they're thinking in those terms, and that's why they sort of changed their rhetoric so severely. And the Treasurer's press conference today suggested that, these challenges are going to require some drastic action. And that for them will probably mean a tighter budget. And Labor Treasurers have done this before. Wayne Swan and Paul Keating have both done a lot of fiscal tightening in the past.
MD at EQ Economics and advisor at Judo Bank, Warren Hogan, thank you as always.